Welcome back to the 14-day course. Today is day 13, Trading Psychology, and we will be covering my definitive guide to a clearer mind, emotionless attitude, and mentality fit for trading. Now, in today's module, we will be covering 4 separate topics. First of all, we will cover the influence of fear and greed, followed by the 14 stages of investor emotions, then plan your trade, trade your plan, and finally, incomparable comparison. Now, in yesterday's module, we went over day 12, part 2 in risk management, and we learned that capital protection is a vital part of trading. Not only does it protect our capital, but it simplifies the entire trade management process. We know when we're getting into the trade and when we're getting out, whether this be in a loss or in profit. You also learned the stop loss and take profit levels for every individual harmonic pattern we have learned so far, and this is for the bat, Gartley, butterfly, and crab. By following your risk management plan, you can be wrong more than you're right and still turn over a small profit month to month. So as we covered yesterday, with a 1% risk per trade, 1 to 2 risk to reward minimum, and a 40% profitability rate, we can still make between 1.5 to 2% a month. And once you become more consistent in your approach, you will increase your rate of profitability for a more desirable return. Of course, if you persevere, you put in the hours, you put in the work on the charts, you're constantly analysing, you're doing everything by the book, you will then start to see better results by default. That's exactly what you would expect. Let's say you are the person who is losing more than they are right, and you're making a small profit month to month. Don't be disheartened by that. Many people will. And just to get this straight, most traders lose. At least 90% of the market are losing money. If you're making a small profit month to month, you're in the top 10% or the top 5% of the market. Consider that a huge success. Now, in our first topic today, the influence of fear and greed, this is a critical part of trading that many traders fail to understand. And fear and greed is what ultimately drives the market. It's an age-old fact that the financial markets are driven by just 2 emotions, which are, of course, fear and greed. And the reason being is because it's human nature. They derive to the innate human ability to survive, the fight or flight instinct that's within all of us. This is what keeps us alive. Of course, the fear, everybody has fears, and this can be in everyday life as well, and this is why it carries across to trading. It could be the fear of heights, it could be a fear of an animal, a fear of a person, whatever it may be. And when it comes to greed, it can be, of course, something quite selfish. It can be the greed for more materialistic items, the greed for more money, even just the greed for more food, which is probably the most common. And these 2 emotions, these simple emotions, they then carry across to trading and investing. You can see these emotions embedded in every single aspect of life. And in trading, this is the gateway to a whole host of other emotions. This is what we'll cover in the second topic today, the 14 stages of investor emotions. So fear and greed, they impact many of the decisions that you make on the charts. And today is not about eliminating your emotions completely. It's more about recognizing that they're present and controlling them professionally. When you're influenced by fear and greed on the charts, it will ruin you as a trader. It will cause you to make decisions that you wouldn't otherwise make if you'd followed your trading plan. And it's the main reason why traders close positions way too early, the fear of a loss, or let positions run too long, the greed for big wins. So the fear of failure and the greed for big wins. That's typically how the market is influenced with fear and greed. And traders will make excuses all day long as to why they interfered with their positions. If you interfered with your positions based on emotions, You'll say, well, the downtrend looked like it was going to continue, so I extended my take profit, and then the market reversed. Well, that's your own fucking fault for not following your trading plan. And the same goes for closing a position too early. Well, it was halfway to hit my stop loss, so I closed it early to cut the loss quick. But then what happened was price reversed and actually hit your take profit level. Again, a very stupid decision. And this is all based on fear and greed. And trust me, this happens every single day in the market. No matter who the trader is, they will be influenced by fear and greed. And those that are making money, they know how to control it effectively. They know that they cannot be influenced by emotions because it will ruin their trading completely. And I believe that most traders lose money because of trading psychology, their lack of mindset and ability to manage emotions, and risk management. But the reason the risk management is out of place is based on the emotions. The greed for big wins, therefore, people risk more money. The fear of failure, therefore, they close their positions before it hits their stop loss. Or they close it in just a very small profit. So they don't actually have a solid risk management plan that they follow. They're simply just influenced by emotions, and that is how they trade. So what we're looking to do is recognize when these emotions are present and control them effectively. So when you're trading based on greed in the market, let's say you have 3 winning positions, you've made yourself 6%, which is huge. It's a huge week or a huge month, whatever it may be. The positive effect of these gains can then lead to overtrading. And this is what happens to most traders in the market. They see that they're making profit. They then start putting on bigger lot sizes. They start over risking. They then start taking very average trading positions that they wouldn't otherwise take. Just because they're making profit, they assume that every single position thereafter will make profit as well. So you can become overconfident in your own ability and assume that all future positions will result in profit. And what happens as a result of that? You lose money. Now, the negative effect of losses can lead to revenge trading. Now, this relates to fear. You're, of course, extremely concerned about your account. You've maybe lost 3 positions, therefore you've lost 3%. You're feeling down. You now know that you need to get back to break even. So you now start revenge trading. This is what we call revenge trading. And you immediately trade after a losing position. And what you're doing here is you're attempting to regain lost capital as quickly as possible. You see that you're down 3% or you're down 10%, whatever the position size may be that you have used. And you start revenge trading and what you're doing is you're trying to scrape as much money back as you can. And what you do in this situation is you place bigger lot sizes, or you're placing trades that you wouldn't otherwise place that are not following your trading plan. You may trade based on support and resistance, and we know that our trading strategy is based on harmonics. And when you're doing this, revenge trading, it typically results in bigger losing positions. And this is why most traders lose. They overtrade because they become overconfident in their ability. They assume that all of their positions are going to make profit, and this is what happens to most new traders. It happened to me. I'm talking from personal experience here. I still remember the days when I had less than £5,000 in my account, and I would make 1,000 in one day based on trading on news with a huge lot size, and I would get lucky. And I can admit that I got lucky. I would then overtrade, and by the end of that trading day, I had lost £1,200, and I was down 200 from where I had started. So I got lucky in the first place, but I was telling myself that I was better than the market. I started overtrading. I lost 400. I lost another 400, then another 400, and guess what? I was down £200. And then I was revenge trading. I was now down £200. So guess what? I started revenge trading, and guess what happened there? I made a little bit of money, and then I lost more money. And this is what really influences most traders in the market. Overtrading and revenge trading, and it's entirely based on fear and greed. Now, to break this down even further, when it comes to a loss, and when you're relating it to fear, it all comes down to the fear of losing real money. Now, for those of you who have used a demo account, have had demo experience, and this is something we'll cover in day 14, a demo account is what we know as a practice account, which allows you to practice trading in a real-time situation. The only difference is you're not using real money. We then have a live account, which is the real deal, and if you're wanting to become a successful trader, you're wanting to grow your account and make profit and trade full-time, you need to open a live account. So most traders, they start off on a demo account, they get used to what they're doing, and then they go over to a live account. Now, when they're trading on a demo account, the emotions aren't really present because you're not managing real money. So you're not going to have the fear of losing real money when you're on a demo account. When you see a loss, you're like, oh, well, I'll just move on to the next one. So they'll make money on a demo account because the emotions aren't present. Then they'll move on to a live account, and that is where the problems start. They move on to a live account and they assume that their performance on the demo account is going to carry over, the results are going to carry over, and they'll keep making money, except it's real this time. And what happens is, and what they've not considered, is emotions. They then are struck with fear when they see that their position is in a loss because they're losing real money. And this can be as little as $10, but the emotion is still present. Nobody likes to lose money, and everybody loves to make money. And that is the problem here. So when it comes to a loss, the fear is, of course, the fear of losing real money. Now, when it comes to profit, it's the fear of underperforming. And this is what I spoke about at the start of the module today in the review. Let's say you are the trader that's losing more than they're winning, but you're still making profit month to month. Many people will then start to say to themselves, I'm not a good trader. I lose 6 times out of 10. I'm only right 40% of the time. They then feel that they need to overtrade to make more profit. Whereas, if you look at it from a statistical perspective, you're actually in the top 5% of the market. You're making profit. That is the hardest part. That you've already conquered the hardest part, is actually making profit. Once you're in that category, you're plain sailing, as long as you keep on track. Now, when it comes to greed, when it comes to a loss, it's the greed to keep what you have. So the greed to keep the money you have in your account, in your trading account. And this is why many people will close their positions on a profit way too early, or they'll close at break even because they don't want to lose any money. Nobody wants to lose money. So when it comes to a loss and people get greedy, they'll close it in a very small win, and they'll try and do this consistently, but it's not a sustainable trading strategy. And then when it comes to profit, the greed for profit is obviously the greed to make more money. When a trade is approaching their take profit level, they'll then adjust their take profit and move it to maybe a third more or twice the size of what their initial take profit was, assuming that the market will continue uptrending or downtrending towards their take profit level. They'll, instead of aiming for 4% or 2% on that trade, they'll aim for double. And what happens? They lose money. 9 times out of 10, they lose money. So what I want to do here is just run through a trading scenario based on fear and greed. So what we have is a bearish bat. This is a currency pair that we're looking at here. I'd love to tell you what one it is, but I forgot. Now, I'm pretty sure it's US dollar Swiss franc on the 1 hour chart. This is a pattern that we took previously, a successful trade, but it's just a picture perfect move based on fear and greed. I absolutely love this. When I look at the chart, it's just perfect. Wait until you see it. So let's say you execute the trade at D. That is, of course, what we do. We execute once price hits D. We enter the potential reversal zone, which is between X and D. This area, we're looking to execute the trade upon completion of the price level at D. So we sell. We short the market. We're looking to sell here. Now we can see that price dropped instantly in profit. That's a good feeling. Then we see the market moves against us and it's actually in a small loss. But you're okay with that. The fear kicks in slightly, but then you see a huge reversal and it's back into profit. So it's a relief. The trade is plain sailing now. It's in profit. It's going to continue downtrending. You're in the clear. Now you see that the market has actually moved up and it's moved against you and it's almost hit your stop loss level. It's at least halfway towards your stop loss. And at this position, this is when most people would close their trade. The fear of losing money would kick in. They would close their trade. I can't take it anymore. It's just going to hit my stop loss anyway. So instead of losing 1% or 2%, I'll lose 0.5% or I'll lose 1%. So most traders will close their position here. It hasn't hit their stop loss yet, hasn't hit their take profit. They'll interfere based on emotions and they'll close their trade. Whereas if they had just held their position, actually it reversed from the resistance at X straight down a very aggressive move and hit your final take profit level. So you can see that by interfering with your trades can actually have an extremely negative effect on your trading results. Whereas if you just stick to your trading plan, everything will go exactly as expected. You will, of course, have losing positions. Everybody does. Nobody is perfect. There is not one trader on this planet that doesn't lose trades. Realize that. Most good traders are right maybe 6 or 7 times out of 10. Now let's say you extended your take profit level. As mentioned, agreed to make more money. You can see that this aggressive downtrend is going to continue. That's what you tell yourself. So you double or you add another third onto your take profit level and you actually extend it all the way down to A. And you tell yourself, this is a really aggressive downtrend. This is going to continue. And what happens? It reverses from your 0.618 take profit level. I've indicated this with a black horizontal line to show you where it was. So that's where you would have closed the trade. You've extended it, and guess what? Your trade moves back to break even, and you don't make any money. And this is just a very simple example of how fear and greed can influence your trading just on a daily trading basis. So just one trading setup. That's only one. Every situation is going to be different, and if you allow yourself to be influenced by these two simple emotions, you will lose money. That I can guarantee. Now, when it comes to support and resistance, and I find this hilarious because this is what most of the market do, and this is why I provide a lot of free educational content as well. I hate to see people lose money and make stupid mistakes. I was that guy when I first started trading. It's also why I love teaching as well. Most people, and this is based on fear and greed as well, when price hits resistance, they assume that price is going to break, so they buy. They can see that price is going up. This is going to continue. This is a good trading position. The uptrend is solid. And they buy. And guess what? Price drops down to support. It's a losing trade. Then you have the people that come into the market that trade based on fear. They can see that price has bounced off resistance. It's hit support. It's going to keep continuing. It's going to break support. This is going to be a winning trade. And they'll sell. Or the people that bought based on greed, once it drops down to support, they'll sell based on fear that the market is going to continue. Then those same people will buy again. They can see that their potentially profitable trade that they closed out of fear actually ended up in a large profit. So they buy at resistance again. They expect price to continue, and guess what happens? They sell out of fear because price drops back down to support. And this just happens over and over and over again. They repeat until broke. They repeat until they blow their account. And the 95%, which are the losing traders, at least 90 to 95% of people lose money. They buy high and they sell low. And that is why they lose money over and over and over again. Now, when we're trading harmonic patterns, what we're doing is we're buying low and we're selling high. And that's exactly what you want to do in the market. That is the aim of the game. And just a quote here, I absolutely love this by Jess Livermore. Wall Street never changes. The pockets change. The suckers change. The stocks change. But Wall Street never changes because human nature never changes. I absolutely love this. Write this down. Keep this noted. And just as a reminder, a simple reminder that the market is driven by fear and greed. Two very simple emotions that can either make or break a trader. Now on to our next topic, the 14 stages of investor emotions. What I'm going to do is just take a very short break and then resume the rest of today's module. Alright, let's continue with our second topic today, the 14 stages of investor emotions. Now, the following emotional cycle is present in all financial markets, and you can pinpoint this in various market situations and identify market sentiment. Now, remember back in day 4, we identified that a type of analysis called market sentiment is how investors feel towards a certain asset. And your goal is to be aware of the range of emotions that may occur and manage them effectively. Now remember, it's not about eliminating your emotions, because that would take a lot of discipline and a lot of time to be able to learn how to do this. Today, it's simply about identifying when they're present and managing them effectively. So identify when the emotion is present, how it makes you feel, what decision is it influencing? Are you trading based on fear? Are you going to close your trade before it hits your stop loss? What about greed? Are you attempting to extend your take profit level? Just identify what these emotions are making you do in the market. Is it driving you towards pleasure? Of course, bigger wins, or away from pain, which is of course a loss. Now the emotional cycle in trading, it starts off with optimism. You have a positive outlook which encourages the investor or trader about the future, and it leads us to buy the asset. Now this applies to at least 90% of the market, and this is how they trade. So it looks good, the trading position that they're taking, the buy or sell. Let's just say, for instance, we buy in this situation because the cycle goes up and down. They buy because they have a positive outlook. This position looks good. Now they can see that their trade goes instantly into profit. They can see that their ideas are working. And people start to consider what their market success could allow them to accomplish. They start to think they're better than the market. They're in a good amount of profit right now. It didn't even go into a short-term loss, just straight into profit. We then move into thrill, which is our third emotion. And at this point, as a trader, we cannot believe our success. And we begin to comment on how smart we are, because we are better than the market. We have just placed a trade instantly into profit and we're up a couple percent. Wow, I feel great about this investment. I feel great about this trade that I took. I'm so smart. And that's what most people will be thinking at this moment in time. Then they hit the stage of euphoria. And this is the point of maximum financial risk. Euphoria marks the point where the market is overextended, where this person is so high in their emotion they can't even see the errors they're about to make. And having seen every decision result in quick and easy profit beforehand, we begin to ignore risk and expect every single trade to become profitable. And this is when you begin to overtrade, as mentioned in the influence of fear and greed. Then we enter the stage of anxiety. For the first time, the market moves against us, and we have never stared at losses in the face just yet. We are new to the market, we have never experienced this, but we tell ourselves that we are long-term traders, we are long-term investors, we're swing traders, and that all of our ideas will eventually work out fine. Then we enter the stage of denial. And this is when the market is not yet rebounded. We don't know how to respond. We begin denying that we made poor choices. Our long-term view now shortens to a near-term hope of an improvement. We can see that all of our profit is now wiped and it's actually quickly heading back towards break-even. And we tell ourselves, it's a temporary setback. I'm a long-term investor. I'm a swing trader. Or I'm a long-term trader. The market will pick back up. It's just a retracement. Then we enter the stage of fear. The market realities become confusing, and we believe our positions in the market will never move in our favor. We can see that we're back at break even. Most people hold on to their positions at this point. It's a big error to make. Then they move on to desperation. And when they move on to desperation, they don't know how to act. We grasp at any idea that will allow us to get back to break even. And this is what most people do on TradingView, funnily enough. They'll see, let's say it's Bitcoin, for example, or it could be a currency pair, it could be Euro US dollar, or even a stock. If they see a top author, or they see someone that they consider to be a better trader than them that has an idea, they have analysis. Now, analysis doesn't always mean they're taking the trade, but they have analysis that indicates that actually this asset, I'm long in this asset once it hits this price. So they'll see that and they'll start grabbing at that idea. They'll take that as fact. They'll take it as 100% correct. This guy's good. I'm going to take his advice. Then they move on to panic. They've exhausted all ideas. They can see that the guy that they actually followed was wrong. And we're at a loss, a huge loss. We don't know what to do next. Then the stage of capitulation. Deciding that our assets will never increase again. We're in a huge loss. We made a huge mistake. We close all of our positions to avoid any future losses. So you can see here, we started off at optimism. We went through the full cycle down to capitulation. Now we're at the bottom of the market. Once we hit despondency and depression, which is next. Now, when we hit capitulation, most people tell themselves, maybe the markets just aren't for me. Maybe I'm just not meant to be a trader. Maybe I picked the wrong thing to try. And this is what most people tell them, and that's why they stop trading and never come back. Then we hit despondency. After exiting the markets, we sell off the assets we're holding, whether this be currencies, commodities, cryptocurrencies, or stocks, whatever it may be. We do not want to trade ever again. We close all of our positions to avoid any future losses. At this point, you've wiped the majority of your trading account because you over-risked during the thrill and euphoria stage. You were adding to your position. You over-risked. You assumed that all positions would make profit. Then you hit the point of depression. And this is the point of maximum financial opportunity. This is the area where you want to buy. When the market is low, we want to buy low and sell high. So as we can see, the point of maximum financial risk, which is euphoria, that's when we want to get rid of our positions. That's when we want to sell or short the market. The point of maximum financial opportunity, when we're at depression lows, this is what we call depression lows in the market. This is the point of maximum financial opportunity, and this is when you're looking to buy. So depression, you start telling yourself how foolish you are. We are left trying to understand our actions. We don't know why we ever held on to that trade through anxiety, denial, fear, desperation, panic, then capitulation. We should have just sold in a profit. Then there's hope. Eventually, we return to the realization that markets move in cycles. We now realize this, and we begin to look for our next opportunity. Then we move on to relief. Eventually, we return to the realization that markets then are picking back up. We can then move back into profit, and we renew our faith that there is a future of trading and investing for us. Then we're optimistic, and we look for our next trading opportunity. Now, there's many ways that this cycle can be explained. This cycle is present in all market situations, all financial markets as well. What I'm going to do is give you an example. This is actually a currency pair. We can see here, we start off at optimism. Now, this cycle can apply to a trader's career. It can be long term, or it can be short term when they're just holding a position. Now, this emotional cycle is more relative to cryptocurrencies and stocks because of how they move, but it still applies to commodities and currencies as well. And this is actually a daily chart we're looking at. Let's say this long-term trader or investor is optimistic and they see the uptrend continuing. They then get excited because they can see that their idea has actually worked. Straight into profit, didn't even go into a short-term loss. They're in a huge profit. The market pulls back, it moves up, then thrill. They can see that their trade is rocketing, and this uptrend is extremely bullish. They can't believe how smart they are that they actually picked out this perfect uptrend. Then they hit the point of euphoria where the market is way overextended, and they're telling themselves how smart they are, and they can't believe how much money they're making right now. Then the market pulls back. Slight anxiety because they can see there's a lot of selling volume in the market. This large long day candle. Then denial. You can see that now they have already lost at least 33% of their profit, a third of their profit or more, almost half. Now they're in denial that the market is actually moving against them. Then fear, because now price is quickly approaching where they enter the trade, but they tell themselves that the market will pick back up and the uptrend will continue. It's just a short-term correction. Then desperation. They're now at break even. They've wiped all of their profits. They didn't stick to their trading plan. They didn't close the trade in a profit. They're actually back at break even, but they hold on. Now panic sets in because they're in a loss. And the moment they close the trade is capitulation. They can't take it anymore. They can't take the thought of losing half of their account or suffering losses any larger than what they have. So they close the position, and quite rightly so, because the market keeps moving down, to despondency and then depression. And people actually hold on to despondency and depression and then close their trades. They sell at the possible lowest point of the market. The worst thing you could do. They sell at the lowest point of the market, and then instantly it rebounds and moves back up above capitulation. We're now into hope. They can see that actually the market is picking back up. Maybe I should have held on to that trade. Well, then it moves back. It's back down to despondency. And the people that held through depression, they didn't sell. Hope is probably the most important part here. We can see that the market moves back, and this is where they say to themselves, I'm a long-term trader, I'm a long-term investor, I'll just hold on to this. And then relief. They can see that it moves higher than the previous high at hope. So the market's still gradually moving up. It's not in an uptrend quite yet. And then we can see back to optimism. They're back at break even. And now they're looking at another move up to euphoria. And actually, I'll tell you what happened after this chart. The market moved back down to depression and even further. And this is why people suffer such large losses in the market. They go through this cycle over and over and over again without even realizing it. They allow fear and greed to influence their trading. Then they open themselves up to this whole host of emotions in the market. And as I've mentioned so many times in the past, 90% of trading is purely psychological, and it is the main reason why so many traders fail, as they let their trading become overruled by their emotions, thus making irrational decisions. Controlling your emotions within the market is your main personal objective. Not becoming an emotional trader. That will take a lot of time to develop, as these emotions are of course human nature, but just identifying when they're present. And this is why self-awareness is an extremely important aspect in trading. So don't blame the market for your mistakes. Don't blame your broker for your mistakes. Don't blame your trading system for your mistakes. These are all things that can be changed. You can change broker. Of course, you can't change the market, but you can change the way you look at the market. You can change your trading system. And don't blame your friends and family as well. Let's say your better half or your partner comes in, your wife, whoever it may be, and they had a bad day and they moaned at you. And then you go off and trade and you lose money. That's not their fault. That's all on you. It's your fault. You need to take 100% responsibility for everything you do in your trading career. Don't blame it on anyone else. No external sources. It's all on you. And you did not lose a trade, or did you lose a trade, sorry, because you didn't follow your trading plan? that's 100% on you as well. The reason we have a trading plan is to, of course, map out how exactly we're going to analyze the market and execute, how we're going to make profit. If you allowed yourself to be influenced by emotions, then of course, one, you're not following your trading plan, and two, you need to take responsibility for that. You need to realize that actually you didn't follow your trading plan, and emotions are actually dictating how you look at the market. So start owning your failures as much as you do your successes. And I find this extremely amusing, because whenever we do something good, we feel good about it. Whenever we make maybe 5 or 10% in the market, we'll tell everyone. We'll tell our friends, our family, maybe not all of you, but some of you will. You'll say that this trading thing's actually working. Or you'll tell other traders. Or it could be anything. Say you get a job promotion, whatever it may be. You're happy for yourself because you're successful. You're making big wins in your life. As soon as you start to fail, you keep quiet. No one owns their failures. And that's what I want you to do. I want you to start owning your failures, not to the point that you're losing all the time, but whenever you do lose, own it. If you lose a trade, own that losing trade. Analyze why you lost. Don't just hide from it and accept it happened and then just move on to the next one and then lose again. I want you to start owning your failures as much as you do your successes. Now moving on to our third topic for today, which is plan your trade, trade your plan. When it comes to trading, you need a clearly defined trading plan that walks you through every single step of how you're going to analyze and execute in the market to make profit. And I absolutely love this quote: if you fail to plan, you are planning to fail. And there's a lot of truth in that. When it comes to new traders with no market experience, they have no sense of direction, they don't plan, and they blindly follow others. And this is something I experience every single day when I get new traders messaging me on TradingView or social media. You may be one of those people if you're doing the course right now. They'll ask for advice based on an asset that has went the wrong way. They've over-risked. I know they've over-risked because they're messaging me. If they risk 1 to 2%, at least half of them wouldn't even worry about their position, but they're over-risking. They've made a bad choice and they've blown a lot of their capital in their account. And they'll message me out of hope, out of desperation, just hoping that I can provide some insight that the market is going to return, it's going to pick back up. And I do help people. I'll provide analysis, not all the time, but most of the time. I'll post it publicly on TradingView so everybody can benefit from it. If I get a lot of requests on one asset, I'll post it on TradingView. And many people, it's not what they want to hear. I'll say that price is actually going to drop down a further 20%. It's going to drop down a further 300 pips. They're expecting me to say it's going to go up 200% or go up 1,000 pips. So I'll always be real. And these traders will always lose. They'll always lose because they don't have a trading plan and they trade based on emotions. And once they change that, that's when they'll see their trading change for the better. So at a certain stage, they will overcome the basic errors and begin to plan their trades. They will develop a trading strategy or a trading plan after losing a lot of money. And then the problem arises again when they see someone else's analysis, this might be mine, for example, on the asset they're trading, which opposes their view of the market. They may consider me to be a far better trader than them, so they'll follow my analysis, although they don't know how to trade my strategy. And then what happens is they'll trade based on emotions. They don't understand the whole concept of how I manage a trade. They may end up losing money. And the main problem in trading is not preparation, but execution. Execution and management based on the initial plan itself. So most people can plan correctly. And this applies to not just trading, but business as well. Ideas are a dime a dozen these days. Most people have excellent ideas. I sit down with a lot of people who are the smartest people I know. They have excellent ideas. They're going to launch a business, they're going to do this, they're going to do that. But that's not what I look for. I look for execution. Can that person execute? No, they can't. And that's what most people lack. They lack execution and they lack management. They lack insight. They can prepare correctly for the situation that's about to happen, but they can't execute. And that happens in trading all the time. People prepare, they'll do their business plan, for example, their trading plan, their business plan. You're preparing for what is about to happen, and then when it comes to execution, they can't do it. It just doesn't happen. So what I want to do here is just go over a very clearly defined trading plan, and you can break this down even further once you go away today. Now, your trading plan should consist of trading goals, your system, and journaling. Now, in order to have an insight on what you're going to do in the market, you need to, of course, set your trading goals. You need to set, of course, based on growth, your monthly target, yearly target, and estimated positions per month. Now, we know that these positions per month will always change. You do have bad weeks in trading. You have quiet weeks in trading. You may even go a month without trading. There has been 1 month in the past, or several months, not together, of course, but over my years of trading, there has been several months where I've had very few positions, just because I've not seen any high quality setups. Now, let's say your monthly target is 6%, which means your yearly target would be around about 100%. And let's say this was based on 7 positions per month on average. Now, as I've mentioned before, let's say you only get 5 positions in your trading month, and you're approaching the end of the 4th week or the 5th week. You're approaching the end of the month. You've only took 5 trades. You've got 2 left. Don't try and squeeze them in. This is just an invisible target. It's not a solid figure you need to hit. This is just a target. Of course, you don't need to get 7 every single month. So don't push out these trading opportunities, these average trading opportunities. Only take a trade when you're satisfied with the opportunity that is presented. Then we move on to our system. After defining our goals, now this is a very basic overview. You can define your goals even further. This can be for life when you want to go full time in trading. You can incorporate my 6-figure breakthrough into this. You can incorporate when you want to be financially free. Everything that involves trading and you're working towards, you can insert in your trading goals. And you can map this out, even just pen and paper. Just write it down and make it clear, make it visible, pin it on your wall. You then want to define your system, which includes, of course, a trading strategy and risk management. Now, your trading strategy, you'll have your overview and then your strategy itself. The overview would be trading timeframes. What timeframes will you focus on? The assets and markets traded, trading hours, type of analysis. So we know that the trading timeframes we focus on is mainly the 1, the 4, and the daily. Now, sometimes I'll focus on the 15, the 1 hour, and the 4 hour. Many people here focus on the 5 minute, the 15 minute, and the 1 hour. This is entirely your choice. Then the assets and markets traded for this strategy alone. Now, I mainly use the same strategy for all financial markets, but there are slight changes between currencies, cryptocurrencies, for example. There are different parts that I will use. They are all based on harmonics, but I will use a slightly different strategy for all of them. So you can put currencies in this box here, or you could put all markets. What are your trading hours? Well, currencies, we are Sunday to Friday. You could even set specific hours every single day. You could set 1 hour before work and 2 or 3 hours after work. You can set clearly strict rules for when you're trading. You know you're only trading on a Tuesday, Thursday, and a Friday. That's entirely your choice. What type of analysis will you incorporate when you're looking at the charts? Of course, we focus on the technical factors of the market. Now, if you want to look at fundamentals, insert this in here. If you want to look at market sentiment, again, you can insert this in here as well. When I look at cryptocurrencies, I look at market sentiment. Then we go on to the strategy. How are we actually going to analyze how price is moving? Well, of course, we look for harmonic patterns. Then multiple time frame analysis. We use our minor, intermediate, and major. Chart structure and key levels. We also look for candlesticks as well. Or do we use indicator confirmation? Do we use RSI? Do we use EMAs or volume? So harmonic patterns, we use all types of harmonic patterns for this market. We don't just use the bat or the crab or maybe just the Gartley. We use all of them. We look at all three time frames, the minor, intermediate, and major, for confirmation. We look for all technical structures that support our initial idea of harmonic patterns. We also look at Japanese candlestick formations in and around the potential reversal zone, which is once price completes D. And then indicator confirmation, let's say for example you wanted to use the relative strength index. Now let's say you didn't want to use indicators, you would put no indicators at all. Let's say you're trading cryptocurrencies, you wanted to look at volume. You wanted to look for market reversals based on volume, you'd put volume in here for confirmation. Now risk management should tie in with your trading strategy. You have your risk per trade, your risk to reward, stop loss, take profit, and trade management. How are you going to manage a trade as it progresses? Your risk per trade may be 1 to 2%. It could be 1% or 2%, or it could be 1 to 2 based on your opinion of the market at that given time. Risk to reward 1 to 2 minimum. I would recommend this for everyone. I wouldn't change this to 1 to 1. You could make it 1 to 3. So you're only trading opportunities that are 1 to 3 risk to reward. Your stop loss is obviously pattern specific. They all have different stop loss levels. Your take profit is 0.382 and 0.618. Your trade management, we know that once price hits 0.382, we need to interfere and move our stop loss to break even. We want to bulletproof the trade. We want to protect our trading account, so we manage the trade. And this is entirely optional. You don't need to do this, but it's a good routine to get into. And this trading system as a whole, once you have all this down, it then filters down into your trading journal. So you can then map out how you're doing. You can keep on track. You can be manageable. You can reflect on how you're doing. Every time you place a trade, it goes into your trading journal. Once you adjust your trading goals, you can even put this into your trading journal. Everything is mapped out in your trading plan, and then it's all filtered down into your trading journal. So successful traders are disciplined in their approach. What I want you to do is identify, execute, and manage. That is all you're doing in trading. You're identifying a potentially profitable trade, a potentially profitable setup. You execute on that setup, and then you manage it correctly until it either results in a loss or in profit. It really is simple stuff. And as soon as you lack in discipline, your account balance will reflect your actions. And trust me, it will. As soon as you lack in discipline, you will see the negative effects. And the key misconception when deviating from a trading plan is it worked once, it will work again. And let's take the 14 stages of investor emotions, for example. This person doesn't have a plan most of the time. But let's say they did. Let's say they had a trading plan. They went from optimism to excitement to thrill. And this is where the thrill is, where their take profit level is. They then extend it way past euphoria. They get to euphoria. They can't believe how much profit they're making. And let's say they did close at euphoria and it worked. It worked this one time. So they tell themselves, I'm smarter than my own system. It will work again. And if you find yourself in this situation, stop to ask yourself why you're not following your trading plan. What is causing you to deviate from your trading plan? What's causing you to change it and make these decisions? Is it emotions? What is it? What is your reason for lacking discipline? Emotional interference? Is it the 14 stages of investor emotions? Is it or trading emotions? Or is it fear and greed? Or is it other traders' opinions? Are you seeing other people's analysis on TradingView which you consider to be more successful than you, better traders than you, so you change your opinion? Or is it because you have a poorly developed trading plan that's not clear enough that you can follow step by step? There can be a multitude of reasons why, but you need to be aware of the decisions you make and the impact it can have on your trading and your trading account, your account balance. Consistency is the key to your success. You must consistently execute on your plan in every single instance of a trade. Your trading plan should map out exactly how you look at a trading scenario, how you analyze the charts. Once you execute upon that, all you need to do is manage the position. Very rarely you should need to interfere with an open trade. And when you do, it shouldn't be out of fear or out of greed. Now onto our final topic for today, incomparable comparison. There is a huge psychological pitfall in trading, and this is comparing yourself to others. I see it all of the time, and it's rich, especially on trading platforms, social media platforms for trading. And this can be comparing yourself to me, other students, institutional traders, Wall Street traders, or that guy on social media that's making big money. Well, so he says. You cannot compare your chapter 1 to their chapter 20. If you're just getting started in trading, you cannot compare your results to someone that has been in the business for a long time. And this applies to all aspects of life as well, not just trading. You can't compare what you have. You can't compare your materialistic items. You can't compare your house, your car, anything to anyone else, because every individual is entirely different from the next. And low confidence stems from the feeling of being inferior. During these periods of low confidence, you will make mistakes in your trading. And trust me, you will. And these are the lowest points in your career when you will want to give up. You'll have that feeling of giving up. This is when you hit the point of, you went through the 14 stages of investor emotions, you've hit the depression phase, you've got extremely low confidence, you keep comparing yourself to other traders who are making money, and this is when you will want to give up. And most do. Most traders do. They never come back to trading, or they give it a few years, they come back and try it again, and guess what? The same thing happens. They feel cheated. It doesn't work. It's a scam. It's not for me. I mean, if it was a if it was a scam, then the whole world wouldn't be involved. You cannot continually compare your situation to someone who has been in the industry for 5 years longer than you. You cannot come in and do the 14-day course and then compare yourself directly to me. Once you've been through the trenches, possibly yes, but you cannot compare yourself to someone who trades in Wall Street who's been in business for 20 years. And you're just getting started. You've just done 14 days of an educational course. You cannot compare yourself directly to someone like that. Focus on yourself. At this stage, you will begin to resent your situation in trading or life. If you don't start focusing on yourself and you're directly comparing your results, your life, everything you do to someone else, you will begin to resent your situation in trading and in life. So start focusing on you. Are you going to continually improve your skill set and grow your capital? Focus on what you are doing. Ignore what your neighbor is doing. Be grateful for what you have now. And this is something that I hope that all of you take on board here, especially if you want a lot of materialistic items in life. You really do need to appreciate and be grateful for what you have now, so you can appreciate and be grateful for what is yet to come. Accept there is always someone who is going to be better than you. This might not be in trading, it could be in life, whatever it may be. They are who they are. There's always going to be someone out there who has more money than you, that's got more materialistic items than you, that has better clothes than you, that looks better than you. They go to the gym, they're bigger than you, they're healthier than you. There's always going to be someone who is better than you. Just accept that. And this applies to trading as well. There's always going to be a better analyst. There's always going to be someone who was right and you were wrong. It always happens. So just focus on what you are doing. Follow your own plan at your own pace. Always reflect on how far you've come throughout your journey. Just take a moment to think back to day one when you started this course. When your vision on trading wasn't very clear, you didn't know exactly how you were going to execute when trading the market. You started day one, you were very optimistic. By now, you're probably feeling extremely confident in your trading ability. Right now, you've probably been analysing charts at least for a couple of days, maybe even weeks, depending on how long it took you to do the 14-day course. So always take time just to stop along the way and reflect on your journey and how far you've come. And it will make you appreciate what you have now. Small actionable steps are how you achieve the goals you set. So most people that don't achieve their goals, they either procrastinate, and the reason they procrastinate is because their goals haven't been broken down into small actionable steps. And that's something I learned throughout my trading career, that when you set these big goals, especially materialistic, or you want to make a lot of money, you want to go full time, you actually need to map out how that's going to happen. How much money do you need to make? What kind of trader do you need to be? What kind of person do you need to be? How much do you need to grow your account by? How much yearly growth do you need? How much starting capital do you need? You need to map out absolutely everything into small steps, small but manageable steps, in order to achieve the goals that you set. Now moving on to rookie mistake number 13. Of course, we're approaching the end of the 14-day course. We've only got one more rookie mistake left, and you can probably guess what this one is. Emotional-based trading. Allowing your emotions to dictate your trading will have a direct effect on your trading account, and your account balance will show this. Trust me, it will deteriorate over time. All of the hard work you've put in will be wiped by such a small error. And I say small because it really is, but although it may be small to me, to the market, at least 90% of the people trading are influenced by emotions. And as I've just mentioned, this is the main reason why over 90% of traders fail. The statistics change quite a lot. I would say it's at least 90%. It could even be as high as 95%. So you really want to be in that top 10, top 5% of the market. If you're making profit, that's where you are. Everybody is driven by emotion. It's human nature, as you've already learned. And today's advice is simply to identify when an emotion is present. Having a bad day, don't trade. If you're stressed out, don't trade. There's always going to be another trading day. The market is always going to be there. However, if you blow your account, that money's not. It'll take you a long time to make that back. So I don't want to see you making small errors that could be prevented just by missing one trading day. There's always going to be trading opportunities. Just tell yourself that. If you miss a trading opportunity, there's always going to be another. There's always the next one. Whether that's weeks from now, months from now, even years from now, if it's a huge investment that you missed, there's always something around the corner. Now, I want you to get into the habit of executing, but if you're having a really bad day, you're extremely emotional, just take a day off the charts. Just don't trade, because your emotions will then be carried onto the charts and you'll start making bad decisions. If you're losing money, you're stressed out during your period of doing analysis, then you execute the trade, you come back, you're still having a bad day, you're going to make mistakes. So that would be my advice for today. If you're having a bad day, or you're stressed out, or you're tied up that day, just take a day off and then come back, reflect, and start again. I would also say, before we end today's module, we're wrapping it up of course, you need to manage your emotions. And you now see why 90% of trading is psychological, how much it can affect what you do on the charts. Emotional awareness, discipline, self-awareness, self-confidence, all extremely important parts of trading. And these are crucial to your trading success. And this is something I say a lot, something that I actually wrote in a few of my free educational posts. Everybody loves it. Master your emotions and you'll master the market. And that's really what it's all about. You're not eliminating your emotions and you'll master the market. You're mastering your emotions so you can master the market. And once you understand the emotions that are present and how they can dictate your trading, then you can correctly focus on going forward and making profit. So today, I want you to map out your trading going forward. I want you to create a solid plan in which you can execute upon. Take the trading plan that I presented today and expand it. Expand it as much as you need to. Write down absolutely everything you need to do in order to make profit. Correctly identify your trading goals, even your life goals as well, and tie them into trading. Where you want to be 1 year from now, 5 years from now, 10 years from now. Set your goals as big as you can. Of course, keep them as realistic when it comes to trading. Don't set a monthly percentage target of 100%. That's unrealistic. But keep them realistic, but also set your goals big. What do you want to achieve? Now, in our next module, which will be Day 13 Trading Psychology Part 2, it will be a 3-topic module. We will cover anticipation versus expectation, followed by the imperfection of trading, and we will finish off with locus of control. It's an extremely in-depth module. I can't wait to go over it. I'd like to thank you guys for joining me on today's module, and I'll see you on the next video.